Hello everyone, welcome back to our channel. Today, we're diving deep into the roller coaster journey of GameStop and AMC stocks. If you're interested in financial markets, stock trading, or just love a good business story, this video is for you. Don't forget to hit the like button, subscribe, and turn on notifications so you won't miss our future content. Let's get started. Our story begins in early 2021, in the midst of a global pandemic. Two companies, GameStop, a brick-and-mortar video game retailer, and AMC, a cinema chain, were struggling. Their traditional business models were being challenged by digital transformation and the pandemic's restrictions. GameStop was grappling with the rise of digital gaming, which threatened its physical retail model. AMC, on the other hand, was hit hard by lockdowns and social distancing measures, with moviegoers staying at home and streaming content instead. But then, something unexpected happened. A group of retail investors on a subreddit called Wall Street Bets started to buy up shares in these companies. This was partly a protest against Wall Street, partly a speculative gamble, and partly a social media phenomenon. These investors noticed that hedge funds had taken out large short positions on these stocks, betting that their prices would fall. The retail investors started buying up the stocks, driving up their prices. This created a short squeeze, where the hedge funds had to buy back the stocks at higher prices to cover their positions, pushing the prices even higher. In a matter of weeks, GameStop's stock price surged from around $18 to an incredible peak of $483 per share. AMC also saw a significant increase, with its stock price rising from under $2 to around $20. This was a windfall for those who got in early, but it also set the stage for a dramatic fall. The peak of this financial phenomenon was nothing short of breathtaking. GameStop, a company that was trading at around $18 per share at the start of 2021, saw its stock price skyrocket to an incredible $483 per share. This represented an increase of nearly 2,600% in just a few weeks. Similarly, AMC, which was trading under $2 per share, saw its stock price rise to around $20. This was a tenfold increase, a significant gain for any investor who had the foresight to buy in early. But what was driving this meteoric rise? The answer lies in the power of collective action. The retail investors on Wall Street Bets were not just buying these stocks individually. They were coordinating their actions, buying in unison to drive up the price. This created a feedback loop, where the rising price attracted more buyers, which pushed the price even higher. At the same time, the hedge funds that had shorted these stocks were feeling the squeeze. As the price rose, they were forced to buy back the stocks at higher prices to cover their positions. This added more fuel to the fire, pushing the price even higher. However, this peak was not to last. The rapid rise in price was based on speculation and hype, not on the fundamental value of the companies. As the frenzy subsided, the price began to fall, setting the stage for the next part of our story, the fall. As the old saying goes, what goes up must come down. And in the case of GameStop and AMC stocks, the fall was as dramatic as the rise. The first signs of trouble came when trading platforms like Robinhood restricted trading on these stocks. This was a controversial move that sparked outrage among retail investors. However, it also served as a reality check, reminding investors that the meteoric rise of these stocks was not sustainable. As the buying frenzy subsided, the price of GameStop and AMC stocks began to plummet. GameStop, which had peaked at $483 per share, fell to under $50 within a matter of weeks. AMC also saw a significant drop, with its stock price falling from around $20 to about $8. This rapid decline was a harsh reality check for many retail investors. Those who had bought in at the peak faced significant losses. Meanwhile, the hedge funds that had shorted these stocks were able to cover their positions, further driving down the price. The fall of GameStop and AMC stocks serves as a cautionary tale about the risks of speculative investing. While the story was framed as a David versus Goliath battle between retail investors and Wall Street, the reality is that many retail investors ended up losing money. In the end, the GameStop and AMC saga is a reminder of the fundamental principles of investing. Do your research, understand the risks, and invest based on the underlying value of a company, not hype or speculation. The aftermath of the GameStop and AMC saga was felt far and wide. It wasn't just about the financial losses or gains. It was about the broader implications for the financial markets and the role of retail investors. Firstly, the event highlighted the power of collective action. The Wall Street Bets subreddit, A community of retail investors had managed to shake the stock market, causing significant losses for some hedge funds. This was a wake-up call for Wall Street, highlighting the growing influence of retail investors. Secondly, the saga sparked a debate about market manipulation and the need for regulatory reform. Some argued that the actions of the Wall Street bets community amounted to market manipulation. Others pointed the finger at the hedge funds and their short-selling practices. This debate has led to calls for greater transparency and regulation in the stock market. Thirdly, the event highlighted the role of social media in investing. Platforms like Reddit, Twitter, and YouTube have become important sources of information for investors. However, they can also spread hype and misinformation, leading to speculative bubbles like the one we saw with GameStop and AMC. Finally, the GameStop and AMC saga served as a cautionary tale for retail investors. While some made significant profits, others were left with substantial losses. It was a stark reminder of the risks of speculative investing and the importance of doing thorough research. The GameStop and AMC saga was more than just a dramatic event in the stock market. It was a reflection of the changing dynamics in the world of investing. It highlighted the growing power of retail investors, the influence of social media, and the need for regulatory reform. As we move forward, these are trends that every investor should keep an eye on. The saga served as a stark reminder of the volatility and unpredictability of the stock market. It showed us that in today's digital age, information can spread rapidly, leading to dramatic swings in stock prices. It also underscored the risks of speculative investing and the importance of conducting thorough research before making investment decisions. Moreover, the GameStop and AMC saga sparked important conversations about market manipulation, the role of social media in investing, and the need for greater transparency and regulation in the stock market. These are complex issues that will continue to shape the future of investing. Finally, this event highlighted the potential of collective action. A group of retail investors on a subreddit managed to take on Wall Street, causing significant losses for some hedge funds. This has implications for the balance of power in the financial markets and could lead to more democratization in the future. In conclusion, the GameStop and AMC saga was a watershed moment in the world of investing. It has left a lasting impact on the stock market, changed perceptions of retail investing, and sparked important debates about the future of finance. As we move forward, these are trends and lessons that every investor should keep an eye on. Thank you for joining us on this journey. If you found this video informative and helpful, please give it a thumbs up, share it with your friends, and subscribe to our channel for more insightful content. And remember, invest wisely. Until next time.